All right, picture this. It's mid November, you're sipping on pumpkin spice latte and scrolling through holiday deals. And meanwhile, the IRS clock is ticking down. Because while tax planning should be a year round habit, the end of the year, that's the crunch time. Here's why. Once January 1st hits, most of your tax moves for this year are locked in. You can't go back and suddenly max out your 401k, make charitable donations, or buy that new laptop for your small business and still claim it for this year's tax year. December 31st is the finish line, and it's closer than you think. So let's talk about what your year-end tax planning really means. It's about being strategic before the year closes so you keep more of your money and send less to Uncle Sam. For individuals, that could mean boosting retirement contributions to lower taxable income, making last minute charitable donations, and yes, those clothes you never wear could count towards itemizable deductions if you qualify, and selling losing investments to offset gains. That's called tax loss harvesting. For small business owners, it's a power move. Maybe you prepay expenses like software or supplies to lower this year's income. Check if you qualify for the qualified business income deduction, or even invest in equipment before year end so you can deduct it under Section 179. But here's the kicker. Good tax planning isn't just about the end of the year, it's about building habits throughout the year so you're not scrambling in December. That means tracking your income, knowing your deductions, and checking your withholdings so you're not surprised in April. Think of year end planning like the last 2 minutes of a football game. The plays you call now can either make or break your final score. So before you wrap those gifts, wrap up your finances. Because if you wait until January, the only thing you'll be able to change is your New Year's resolution.